being and current, having to write about this every day. You're just a trooper, by the way. Thank you, Enda, for coming back in, because you're covering this conference as we go on again, off again with Jay Powell here. He's already made news, though. And the idea of reaching 2% next year seems to be confounding even the chairman.
It's been a very lively event and a very important speech. Coming into it, the story was the Fed is on hold, the rate hiking cycle might be over, but it sounds like he's used his opportunity to do a bit of a course correction. Everybody needs to calm down. They're nowhere near back to 2% inflation target. He doesn't want any head fakes over a few months of good data, that's how he termed it, and he made it explicit that they won't hesitate to raise rates again if they need to. Now, you might say that doesn't change anything. We know they're data dependent, but he's put this warning back out there again.
Do you think it's because in the aftermath of the Fed's decision in his speech, when they held rates last week, was that last week? Time was all running together for me. That was last week, right?
So crazy.
Yes, okay.
Was.
Feels like it might have been a year ago, but it was indeed last week. What we saw, though, was an easing of financial conditions after that, because everybody's like, okay, cool, Fed's done.
Yeah.
Let's rally again. So is this maybe him just talking to the market, saying, okay, we need things to tighten back up?
It feels like that, Kelly, because nothing has changed dramatically on the data front, right? In fact, we've had very little data this week anyway. I wonder if behind the scenes the Fed thought, wait a minute, that narrative has gone too far there. The markets have taken this too far. We do not want to take the option of a rate hike off the table. This story is not yet over. And that's what he's trying to remind everybody. But the markets clearly don't like it today.
Well, what do we think we hear when Jay Powell comes back? It seems like he's made the news here, but he can always surprise us. What do you have your eyes on?
He certainly made the news on the US policy front, no doubt about it. I think for the rest of the conversation, it might be more globally focused, but it might be some conversation on supply chains and geopolitical tensions and how that's going to feed into inflation going forward and the kind of bigger structural issues that central bankers are facing. I can't imagine he'll add too much more to the warning that they won't hesitate to raise rates again if they need to. I mean, that's a big takeaway from the Fed.
Yeah, and of course, it kind of speaks to this idea, Enda, that predominantly what we latch onto, although maybe to a lesser degree as we get toward the latter stages of this particular hiking cycle, is the inflation story, not the other side of the dual mandate, the employment story. This Fed is still going to react to inflation no matter what happens in the labor market, right? That's still where we are.
Yeah, and they have to. And we haven't seen any... the inflation has been heading in the right direction, but it's not yet where it should be, which is the 2% target that the Fed is mandated to get it back to. Most people don't expect it to get there until maybe sometime next year. The jobs market is still tight. Our own economists today were making the point that, this time last year, people were talking about the need for a much softer employment market to bring down inflation. That really hasn't happened yet. So we're in a space where the Fed is not yet happy where inflation is at, and that means there's still a risk that interest rates may go up, and that's a risk for everyone's mortgage.
How concerned is Jay Powell about Israel right now, never mind Ukraine, as wild cards in his forecasting in any action the Fed might take next year?
And I think this will be a talking point. The Bank of Israel governor, by the way, is on the panel with them. Obviously, it's not really a central banker's purview per se. They'll acknowledge a humanitarian disaster, but I think they will speak about the risks on the economic side being if the conflict worsens, and of course that feeds into the obvious one being oil in the Middle East, and it sends up the cost of oil. Obviously, that has implications for the US in terms of gasoline prices for consumers, then how that might translate into a tax on consumers at a time when interest rates are already high and the economy is broadly slowing. Definitely, I don't think a policymaker wants a big spike in oil prices at the moment. So I think it will be a talking point as this panel goes on.
Yeah, even though usually the Fed likes to say it's looking through energy and food prices because they're volatile, but this is kind of a point that a lot of the candidates on the debate stage last night were making as well. Everybody was talking about what they would do to counter inflation, and pretty much all of them said, unleash American energy, that energy is the solution. And even when the moderators from NBC pushed back, some of the responses were, look, energy costs feed into everything. How you get food to the grocery store, it's driven on a truck, and that truck driver needs to fill up with gas. And once, all of those costs just kind of amplify, which just speaks to the idea that, okay, sure, you look at core, but energy prices can still affect core.
It's what affects everyone's wallet. Consumer confidence is already at a 5-month low. You can argue the technical slicing and dicing of data, but if the price of the gas pump is high, everyone feels that.
And it shows up in the polls, John.
Well, and it's food and energy. It's the two things, right? We obsess over core, but it's the very thing that the president hears about. It's the thing that lawmakers talk to us about when they come on the air here. It's what people spend at the grocery store and at the gas station. And if you look at things around the country, look, they've made a lot of progress when it comes to gas prices. And you have to acknowledge that.
Compared to other parts of the world, I mean, the US has not had the energy crisis that Western Europe had gas prices here never went anywhere near the levels they did there. Of course, also the US is in a different space to the 70s oil shock when they were a big importer of oil. That's not the story anymore now. The US is very much more self-reliant. It's the world's biggest exporter of LNG, for example. So the oil shock story isn't quite what it once was for the US, but it's still a risk. It's still a threat. And if it does flow through, it will hit consumers hard. Sure, it might be a wash in inflation data once you average it out, but it's a near-term threat, and I don't think any lawmaker or any Fed official would like to see that happen.
Absolutely. You look across the country, though, there's still over $5 in California.
I believe it.
It's incredibly stubborn. Enda Curran, great to have you with us. Many thanks for ducking out of your coverage here to talk to us on Bloomberg Sound On. When you see the headlines roll on the terminal coming up here, when Jay Powell starts talking again, you can know that it's Enda who's watching and typing. I'm Joe Matthew alongside Kaylee Lyons, and a fascinating conversation here that I didn't even know we were going to be having, but that's the way things go in Washington when somebody starts speaking and making news.
Yes, even if they're briefly interrupted while speaking because of climate protesters,
Sometimes
which is
that can become the news.
An entirely
Everybody's tweeting
different
about
political
that now,
dialogue.
Huh? It's like a big thing on.
Yeah, he had some
socials.
choice words, I guess,
he
as
did.
he was leaving the room, and we're not going to share those on radio because that would be not appropriate.
He's a Grateful Dead fan. He's a peaceful man. Very good. Let's get you up to date on things. Nancy Lyons joins now from the Bloomberg 99.1 Newsroom in Washington with the latest world and national news. Hi, Nancy.
Thanks, Joe. The Biden administration is placing more pressure on Israel to curb civilian deaths in Gaza as Israel wages war against Hamas following the group's terror attack in Israel. The president today said it is taking longer than he'd hoped for Israel's prime minister to follow through with some of the White House's suggestions. White House National Security spokesman John Kirby says Israel is taking steps concerning the safe passage of civilians and humanitarian aid in Gaza.
We understand that Israel will begin to implement 4-hour pauses in areas of northern Gaza each day, with an announcement to be made 3 hours beforehand.
Kirby says the process is beginning today. While much of the focus on the world is on the fighting in Gaza, Israeli officials are working to identify those who were killed in the October 7th attack. They've sought help from archaeologists who are more used to studying ancient ruins. So far, the Israel Antiquities Authority has been able to locate remains of more than 40 people. President Biden is still facing a tough re-election fight with less than a year left in the campaign, but it's not for lack of trying, as we hear from Bloomberg's Nathan Hager in Washington.
President Biden is flooding the zone with campaign ads to beat back at voters' two biggest concerns about him, his age.
In the middle of a war zone, Joe Biden showed the world what America is made of.
And the economy.
Today, unemployment is at record lows. Our economy leading the world.
The tracking firm Ad Impact says the president's already spent $39 million more than the last two presidents at this point in their re-election bids. In Washington, I'm Nathan Hager, Bloomberg Radio.
Apple co-founder Steve Wozniak remains hospitalized in Mexico City following a health problem while he was in the city to speak at a business conference. Anonymous sources say he's stable, but they refuse to go into any details. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
News, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with a developing story. West Virginia Democratic Senator Joe Manchin says he will not seek re-election. We've got more on the implications of that announcement and reaction coming up in just a moment right here on Sound On. But the headline worth repeating, West Virginia Democratic Senator Joe Manchin says he will not seek re-election. Fed Chair Jay Powell says the central bank will not hesitate to tighten policy further if appropriate, and reiterated that the central bank is not fully confident that it has tightened enough to return inflation to 2%. His remarks came live here on Bloomberg Radio.
The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so.
The Fed chair's speech at the International Monetary Fund, though, was interrupted just as he started by climate protesters.
Powell, by refusing to treat climate change like a systemic risk,
thank you.
You are putting us at
Thank you very much.
disaster.
Thank you very much.
Yep.
Thank you.
They were eventually cleared out. Powell's speech resumed, and so did the market declines. S&P 500 index down 32 points right now. Lows of the day, we have got the S&P down by 0.7%. The Dow down 229, down 0.7. NASDAQ is lower by 111, a drop there of 0.8%. 10-year yield 4.63%. The 2-year 5.02%. Spot gold up 0.4%. 19.57 the ounce, and West Texas Intermediate crude up 0.3%, 75.52 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
You're listening to Bloomberg Sound On with Joe Matthew and Kaylee Lines on Bloomberg Radio.
With breaking news from Washington, as you've just heard from Charlie Pellet, Joe Manchin shakes things up today, says he will not seek re-election. The senator from West Virginia just a moment ago taking to a video announcement. Here he is, Joe Manchin, letting us all know his plans.
After months of deliberation and long conversation with my family, I believe in my heart of hearts that I have accomplished what I set out to do for West Virginia. I have made one of the toughest decisions of my life and decided that I will not be running for re-election to the United States Senate. But what I will be doing is traveling the country and speaking out to see if there is an interest in creating a movement to mobilize the middle and bring Americans together.
Well, what is this he speaks of? Remember, we spoke with the co-chair, one of several national co-chairs of No Labels. This was former Governor McCrory of North Carolina, who said on Super Tuesday, if Joe Biden and Donald Trump are the nominees, we will run a candidate. It was that day that he appeared in New Hampshire at a big event with, yes, Joe Manchin. And so there have been a lot of questions about whether that is, in fact, the next step for the soon-to-be former senator from West Virginia, who at many times has been a thorn in the side of Joe Biden. I know they're both Democrats. Remember this, August of 2022, the president.
And Joe, I never had a doubt. Joe had an operation on his shoulder. I just want you to know it wasn't because of anything we did. He's in great shape.
That day came in a sling. Look, go back to infrastructure, go back to Build Back Better, go back to that entire year of legislative initiatives by this administration. It always came down to Joe Manchin and Kyrsten Sinema. And now the question will be, of course, what does he do and what happens to that seat in West Virginia? In the clutch, we look to Wendy Benjaminson. Here at Bloomberg, of course, Washington senior editor, literally just diving into the studio to help us with this. You didn't see this coming today. Joe Manchin.
This was not on my to-do list today, Joe.
No, it wasn't on mine either. And he's pointing to what sure sounds like a third-party run for president. He's going to travel the country to hear about what?
It did. It really did sound like that, although we don't know. We don't know. Manchin also could be thinking about 2028 for president. He could be thinking about a lot of things. He certainly could read the tea leaves and could see that Governor Jim Justice of West Virginia, who is running for his seat as a Republican, was up by a number of points in a lot of polls. Very popular guy. Manchin also comes from a dynastic West Virginia political family, but still has a D by his name, and that's become a problem in that state. And so he certainly has plenty of options. We are, in fact, looking to No Labels to see what they have to say about it right now, but it just happened.
Well, absolutely. And I'm sure No Labels doesn't exactly know still what it really wants to do. But unleashing Manchin is fascinating when we try to understand what their plans are. What will Democrats' plans be for the U.S. Senate?
That it is a major blow to Democrats' efforts to hold the Senate in 2024. They barely have the Senate now. There are a lot of races that could go either way in 2024. There's a lot of competitive races. I think they may have already been doing the calculus that Manchin may have been going down. But Ruben Gallego is ahead in Arizona.
Yeah.
We are still a year out, though.
That's right.
A lot can change. But this certainly makes the job harder for the Democratic Senate.
You're, of course, referring to the cinema seat.
Yes.
Right?
Yes,
I mean, these were the two problem children for Joe Biden. And they're both leaving. Did he see this coming in the long view?
I do not think the Biden campaign saw this coming.
One becomes an independent, the other one bails to do something else altogether, and Chuck Schumer's left up there scratching his head now.
Absolutely. And, this comes on the heels of Tuesday's great night for Democrats, where they held the Virginia legislature, in fact, gained in the Virginia legislature.
Yeah.
Ohio enshrined abortion rights in a Trump plus, 10 state. And, but now they're losing, even if he was a thorn in the side of the Biden administration, that D kept them in the majority.
It's pretty remarkable considering that role he played with the administration when it came to the most important pieces of legislation. Build Back Better never became law, largely because of Joe Manchin, we can say. It did become the IRA. There were a lot of other things that the president wanted to do. Joe Manchin wouldn't let happen.
Joe Manchin was the centrist's centrist.
That's right.
He was a Democrat in a Trump state. But he came up, his father was, I'm going to make a mistake. His father was either governor or speaker of the West Virginia State House. I don't remember. And, but that was when it was coal country Democrats. Then it became coal country Republicans, and Manchin survived that. But in West Virginia, you cannot be a total clean energy Democrat and survive. So he always tried to thread that needle for the people of his state. Now, if he does go for an independent or third-party run, that's going to make it very, very difficult, because the people who feel that Biden may have gone too far to the left or is too old or all the other things are looking at this guy who actually is in his 70s, I think. But younger than Biden and a true old-style conservative Democrat.
To think, though, that he could be the thorn in the side of this president on all of these legislative issues and then end up being his undoing. If he runs as a third party,
where's Shakespeare to write the play?
Absolutely. We should note, though, the conventional wisdom is that would be the difference between a Joe Biden or a Donald Trump victory.
Yes, because all those independent voters who aren't crazy about Biden, who aren't crazy about Trump, here's an alternative.
Right.
And it's an alternative that's not Robert F. Kennedy Jr.
That's right, sure. And they're looking at swing states that would, in fact, choose the next president, most likely.
And here we are in this unprecedented year, and something like this would be unprecedented, a third-party candidate.
Amazing.
Surging.
Yeah,
but we don't even know if he's running yet.
Fair enough. We don't know.
I only put out 2 paragraphs.
And yeah, absolutely. You're going to go back into a very busy newsroom, I think, here. Are you editing this story, by the way? I love the behind-the-scenes stuff. We follow the life and times of poor Wendy Benjaminson when we call someone for some expertise here. But the video was clearly, well-produced. Did you notice he got a haircut today?
He did.
And I'll be curious to see what happens, of course, next. Joe Manchin, the senator from West Virginia, not running for re-election. It's a breaker right now that you're hearing about on Bloomberg. Read the story on the terminal and at Bloomberg.com. Many thanks, of course, to our Washington senior editor, Wendy Benjaminson, with the analysis in the clutch. As always, I'm Joe Matthew in Washington. We'll have some final thoughts ahead. The way this day's been going, maybe another headline for you. Stay where you are. On the fastest show in politics, this is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Bloomberg Sound On, brought to you by the Jewish Communal Fund. JCF helps you respond to crises swiftly. Open your JCF, a donor-advised fund, now to secure your tax deduction. Visit jcfny.org or call 212-752-8277, 212-752-8277. 8277. ARM Holding shares are trading lower after the company gave a disappointing sales forecast amid a slump in smartphone sales and uncertain timing for new licensing deals. Today, we're looking at shares of ARM Holdings, and they are down now by just about 5.7%. NVIDIA higher after, according to a report from state-affiliated news outlet China Star Market, NVIDIA will release 3 new artificial intelligence chips for China. This comes after the U.S. further restricted the Asian nation's access to advanced semiconductors last month. And today we are looking at NVIDIA shares, and they are up by about 0.9%. Bloom Energy is surging after the hydrogen fuel cell company reported better than expected earnings per share for the third quarter. Bloom Energy up now by 9.7%. Dow member Walt Disney gaining by the most in a year after reporting better than expected profits and vowing to cut $2 billion in expenses as it faces pressure from activist investor Nelson Peltz. And those are our top company stories at this hour. And this is Bloomberg.
You're listening to Bloomberg Sound On with Joe Matthew and Kaylee Lines on Bloomberg Radio.
Live from Washington, where we keep you up to date all day long here. World and national news with Nancy Lyons now on the Bloomberg 99.1 Newsroom in Washington. Hi, Nancy.
Thanks, Joe. Well, as you've been hearing here on Bloomberg, Democrat Joe Manchin, the senator from West Virginia, says he will not be running for re-election. He made the announcement in a social media post.
I believe in my heart of hearts that I have accomplished what I set out to do for West Virginia. I have made one of the toughest decisions of my life and decided that I will not be running for re-election to the United States Senate.
The 75-year-old Manchin says what he will be doing is traveling the country and speaking out to see if there's an interest in creating a movement to mobilize the middle and bring Americans together. For the last few years, Manchin has been the only Democrat elected to statewide office in West Virginia. He's a longtime politician there. He served as governor, secretary of state, and as a state legislator. The top Democrat in the House is warning of a possible government shutdown next week. House Minority Leader Hakeem Jeffries called on Republicans to work with Democrats to keep the government open beyond the November 17th deadline. He says if that doesn't happen,
the only approach is to pass a continuing resolution at the fiscal year 2023 levels. Period. Full stop.
Jeffries says Democrats in the House will not pay, as he calls it, a single right-wing ransom demand from Republicans. Speaker Mike Johnson has yet to roll out a plan to fund the government since securing the Speaker's gavel last month. Israel is agreeing to a 4-hour daily humanitarian pause in fighting in northern Gaza to allow civilians to flee. U.S. National Security Council spokesman John Kirby.
Now, we've been told by the Israelis that there will be no military operations in these areas over the duration of the pause, and that this process is starting today.
Kirby says the Israelis have committed to announcing each 4-hour window at least 3 hours in advance. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Joe and Kaylee.
All right, Nancy, thank you. Pretty seismic headline, Kaylee, coming out of West Virginia today. 76 years old, Joe Manchin. Didn't realize he was that old, actually. But I did see him on TV this morning. He had a haircut.
Okay.
He had like a really short haircut. And I thought, now I think I know why he got the haircut.
Pre-announcement makeover.
He's got the haircut in the announcement video, absolutely.
The day after the Republican primary debate, Joe, what do we make of this, timing-wise?
It's remarkable. And I can't imagine the conversations at the White House today. Never mind in Chuck Schumer's office, because it just got a lot harder for Democrats to keep the Senate in a year.
Yeah, and it could potentially be harder for the Democrat to keep the White House if there is an entrant of someone like Joe Manchin,
that's
right?
Where we're going here.
The
So
thing.
he says he's going to travel the country. This is what we're talking about, the potential no labels. It was on this program that they told us it would be Super Tuesday. If it's Trump and Biden, they will run a candidate.
Yes.
Now, we've heard about Larry Hogan. started looking like Joe Manchin wasn't in that conversation anymore, but maybe that's exactly what he plans to do.
Or maybe he'll do it without no labels. Maybe he'll run as an independent. He didn't say anything about seeking another office. All he said is he is not seeking to be reelected to the office he currently holds. So it leaves a lot of questions unanswered. But man, this is not what I was expecting on this Thursday,
Joe. That's true. And meanwhile, Jim Justice is smiling, right? He's glad he turned from Democrat to Republican during the Trump administration, because now it looks like this could be a very easy ride for him. Alex Mooney also running for the nomination, and that'll be the race we're watching instead of the one with Joe Manchin.
But to your point, this could change the math in the Senate.
Yeah,
there already were.
Instead of the one with Joe Manchin.
But to your point, this could change the math in the Senate.
Yeah,
there already were a number of Democratic incumbent senators who are facing tough races in 2024. Joe Manchin, of course, was one of them. But when you're talking about such a slim majority for the Democrats, and now it looks probably pretty likely the West Virginia seat's going to go to a Republican. Math gets tougher and tougher.
Kirsten Sinema, at least from
an
the
independent
party,
now.
What we used to call Manchinima.
Yeah.
Now neither of them will be in the Democratic Senate. Absolutely remarkable. Stephen Dennis already has a full story up on the terminal and at Bloomberg.com if you want to read about it. And Kaylee, I'll meet you back here for more history tomorrow.
Perfect.
I mean, it's like every time you turn around.
I know.
That's why you have to be with us on the fastest show in politics. I'm Joe Matthew in Washington alongside Kaylee Lyons. Bloomberg Business Week starts right now.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a good afternoon, everyone. Live from the Bloomberg Interactive Brokers studio in New York. We're streaming on YouTube. We're on Bloomberg Originals. Thursday, November 9th, 2023. I'm Tim Stenivek, along with my co-host for the afternoon, Barry Ritholtz. He's in for Carol Masser this afternoon. You know him because he's everywhere. He's the host of Masters in Business on Bloomberg Radio, 10 a.m. on a Saturday morning. Also, catch him on the podcast as well. He's also the chairman and CIO at Ritholtz Wealth Management. They've got around $4 billion in assets under management. Barry, welcome to Bloomberg Business Week.
Well, thank you so much for having me. These are big shoes to fill.
They are, and we're very excited to have you. We are seeing the S&P 500 lower right now by 0.9%, the NASDAQ down by more than 1%, the Dow down by 0.7%. I thought, Barry, that today might be the day where we see the longest rally in since 2006, something like that?
Yeah, this has been, you get deeply oversold and everybody is concerned that rates are going to keep going up. And suddenly the Fed realizes what most of us realized back in May. We're good. We're done. Inflation is down. Things look pretty okay. You don't have to cause more economic distress. And the market seemed to rally, or at least that's my after-the-fact narrative telling the story.
All right, I believe it, but Fed Chair Jay Powell would push back a little bit on that. We did hear from him a little earlier. He's right now at the IMF's annual research conference in Washington. He did say, and stocks moved lower on this, Barry, he won't hesitate to tighten policy further if appropriate. And he also reiterated the central bank is not fully confident that it has tightened enough to return inflation to 2%. So throwing a little water on the rally.
Yeah, I can't hear what he's saying because what he's doing is speaking so loudly. They haven't raised rates in a couple of meetings. And we know when we take apart whether it's CPI or the PCE deflator, whatever their preferred measure of inflation, they rely on very dated housing information. When you look at current information, even Case-Shiller is so dated, is way ahead of the Fed info, or something like apartmentlist.com. For inflation, they've been disinflating apartment rentals, and it's about to tip into deflation in housing. But the Fed is relying on data that is literally a year old. It's very hard to make policy when, hey, look at what's happening in apartments in December 2022.
Okay, but if you exclude housing and you use other data like PCE, CPI, monthly jobs report, that's more frequent.
Much more frequent. They're all models, and all models are wrong, but some are useful. And we frequently find ourselves looking at these models and trying to figure out, hey, this is a good baseline to judge how we're going to look at the world, but you have to be aware they're not especially precise. They're frequently adjusted and readjusted, and you get the, CPI or GDP is a perfect example. You get the first GDP, then you get the updated GDP, and then you get the revised and updated GDP, and by then it's already 4 months old, and why do we care about GDP 2 quarters ago? So the same thing seems to happen in inflation, and look, it doesn't normally matter, but when one of the most important policy-making apparatuses of the entire economy and government is relying on very dated, very stale information, it's a concern. It runs the risk of an unforced error, causing a recession when it's absolutely not necessary.
Okay, so what data is available? What data should they be looking at? If you were Fed chair, what data would you be referring to?
So, by the way, everything I'm saying, the Fed is well aware of. This isn't like, no one's going to hear this and go, ooh, I had no idea. One of the regional Feds did a internal study trying to find a way to improve owner's equivalent rent, which goes back to, I think, 1980 or 1982, which is how the Federal Reserve figures out what housing inflation is like. They literally call a few thousand people each month and say, hey, hypothetically, you're going to rent out your basement. What do you think you're going to get? What would you have gotten last year? What do you think you would get next year? I'm exaggerating for effect slightly, but essentially it's a survey, and therefore it's not transaction-based, it's not market-based.
Right, nobody knows exactly what rent they're going to get if they were to rent out a space. They think they know.
You could tell what actual rentals are going for. The problem is you sign a 1 or a 2 year lease. It only comes up every year. If your lease comes up in the middle of a pandemic and landlords are making deals, suddenly you have a 10, 15% deflation in housing. When fast forward 2 years, there's no homes available for sale. Now, especially with the golden handcuffs of, I think we're 60% of people with mortgages are at or under 4%.
Yeah.
It's a wild number. So there's just no supply out there. I think that forces a lot of people into rentals who would rather be buyers.
Okay, you spent a lot of time talking about the housing market, which I totally understand. It's a really important one. It certainly drives a lot of spending. But what about other parts of the economy that Fed Chair Powell wants to slow down?
Sure. Last point on housing. Just keep in mind, it's something like 35% of CPI, 40% of PCE.
So there's a reason why you're talking a lot about it.
It's massive, right. You want to talk about energy? Where are we? $78, $79 a barrel?
Yeah.
If you would have asked me a year ago, hey, this war, this Russian aggression into Ukraine is going to keep going. Oh, and by the way, late 2023,
there's going to be a
shooting war in the Middle East.
Yeah.
I would say 100, 125. The fact that it is where it is a pretty strong indicator. Look, all of this goes back to this form of inflation that we had following the pandemic and the lockdown. It's literally not your father's inflation. It's not the 1970s inflation. It's not even the surge of inflation we saw in the mid-2000s. It's driven by shortages of important things, houses, semiconductors, and labor primarily. And it's also, the snarled up supply chain was a factor, and now that has seemed to unwound itself.
Okay, what about the labor market?
So labor is kind of a fascinating area for a couple of reasons. We all have a tendency to take a snapshot and look at what's happening right now. Let's zoom out and look at the labor market long term. You had 3 decades of let's just call it the bottom half of the labor market, deflationary, not keeping up with the stock market, certainly not keeping up with executive pay, but also not keeping up with things like simple inflation or productivity. So for decades, the bottom half of the labor market did very poorly. Now, lock those people in their houses for 2 years, give them a lot of money and say, figure out what you're going to do with the rest of your life. Guess what? A lot of those people upped their skills. They started businesses. You talk to the younger generation, they're very comfortable developing apps, working on websites. There's a whole crazy story in the Washington Post about how OnlyFans has become a $5 or $6 billion creator industry. So people have said, I don't want the poor paying, unsatisfying, no future career business. And that's why, it's so hard to find waiters or nurses and now teachers. The whole craziness with the book banning, we're going to lose a whole generation of teachers.
The book banning is part of is part of it. But I also talk to teachers who are in the local schools where I live in Brooklyn, and they see the way that so many of the parents are able to work from home and they have the flexibility. And these teachers, we know teacher salaries are not good. They need to be higher. I think that's fair to say. Many people agree with that. But it also lacks the flexibility that a lot of jobs in this day and age have. And I wonder to what extent they're going to have trouble attracting and retaining talent in that setting.
So this is the challenge, is that the entire labor system is in this massive flux, and we're going through the shift. And you could see that in all of the work stoppages and strikes that have mostly been resolved in favor of labor, not capital. You go back 10, 20 years, there's a strike. The strikers lost 9 times out of 10.
We are seeing strength in the labor movement right now.
UAW, the Writers Guild, the Actors Guild, pretty much wherever you look. The pilots union, for a long time, pilots were just not getting raises.
So isn't that inflationary?
It's inflationary for 3 months, but if you're not getting increases for 10 years, a lot of this goes back to the lobbying on the minimum wage. And what you ended up doing, and this is a much bigger picture discussion, but by keeping minimum wage low, you essentially subsidize shops like McDonald's and Walmart's, right? Remember, McDonald's famously had a McHelpline. Figure out how to get food stamps for employees. Get food stamps, get aid to dependent children, get all this stuff, because we're going to pay you as little as we can. The ironic thing is suddenly a disruptor like Amazon comes in and says, oh, you don't want to pay these people? Great. We're going to pay $15 an hour while you're still paying $8.
We're going to have benefits. And we're going to have career coaching. We're going to have ways you can get a diploma and do learning while you're an employee here. Yeah,
exactly. And we're going to scoop up the best employees out there. So Starbucks, that was part of their approach. We'll talk to someone a little later about Starbucks. But Amazon did this very effectively. We talk about a minimum wage of $9.75 on a national basis. That's not the real minimum wage. Any place Amazon is in town, the minimum wage is now $15, set by Bezos and Company.
Barry, I'm going to hold you on that comment just for now. That voice you're hearing, Barry Ritholtz, he's in for Carol Master this afternoon. He's the host of Masters in Business on Bloomberg Radio, also the chairman and CIO at Ritholtz Wealth Management. We are waiting right now Fed Chair Jay Powell, who's speaking at an event in Washington, D.C., Monetary Policy Challenges in a Global Economy. He's on a panel down there. It's part of an IMF research conference. Let's head to Washington and take a listen.
That was our goal. And I think, as of now, as I showed you, the exchange rate sort of through events, obviously it's related to the events that are actually happening in Israel as well, but it gave it time. It didn't drift into panic mode, and that was the role of, and still is the role of FX intervention. When you have risk premia go up, that's the number one concern. There are people, when it happened, immediately say you should lower interest rates, help the economy. No, the two go hand in hand together. The idea was to stabilize the exchange rate. The exchange rate stability had periphery effects on the bond market and the stock market in Israel. They continue all to function. We came with the other prong approach with the targeted things for the households, and that was the way we sort of aimed at it.
So if I can, and in the meantime, if you are planning to ask a question, I will ask you to go and put yourself behind one of the mics so we can directly move to the questions afterwards. But before we turn to that, let me actually follow up with one question for Amir and Jay. Jay, there's this incredible resilience in the U.S. economy that, Gita mentioned. We've had this decline in inflation, and the economy seems to be powering ahead. Growth is really at a very high level. Consumption is very, very strong. There's this question about whether transmission of monetary policy is different this time around. Now, in your remarks, you've alluded to the fact that the sequence of shocks we've had is quite different from the typical business cycle. And so I was curious, and I would like to ask the same question to Amir, because in the context of the tightening of policy that you have done at the Bank of Israel, and maybe some of these resilience that Ken was talking about, building a stronger monetary policy framework, building reserves, et cetera, whether there is a sense in which the tightening operates in slightly different ways, there are longer delays, shorter delays. How do you view this from your own vantage point?
Go ahead. So I would say a couple things. Clearly, the U.S. economy has been stronger than expected. It's been more resilient, and this year is just remarkable, really. So many forecasters had a recession this year, and it's nothing like that. It's going to be close to 2.5% growth this year. But that's probably, in my thinking, probably significantly a function of strong demand. I think monetary policy is generally working in the ways that we think it should work, which is interest-sensitive spending, asset prices, exchange rate. I think there are some aspects of the U.S. economy where you can argue that it's a little different, and that would be, for example, households who are in low-rate mortgages are not selling their homes, but they're also not feeling the effects of higher rates because they really don't want to get out of those mortgages. Same thing with companies. Any company that had access to fixed-rate borrowing and didn't use that in the last 3 or 4 years would be facing, but there are very few companies that are in that. So it may be that the U.S. economy is structurally a little bit more resilient to interest rates, but I don't think that I don't see at this point anything that seems to be structurally or materially in the nature of a difference.
Amir.
I sort of agree with Jay. I think the famous long lead, lags, it may be a bit longer. Partly people came out of COVID with a lot of savings. So the potency and the effect of monetary policy took longer, the adjustments of both supply and demand. But I think at least Israel also had, as I shown, a very strong recovery, and we are still above trend, but we're slowing down. So the effect of monetary policy was kicking in before this whole event. Inflation was probably on its way to our target in Q1 24. It just took, in my opinion, a little bit longer for these adjustments to happen. I also agree with Jay in his speech that the issue of supply, to look through supply, was there's a time to do that, but once inflation gets too high and too long, the expectation channel is so important. And as long as that was anchored in monetary policy, ultimately would kick in. It did take a little bit longer.
Okay, Jay.
I just want to, for a second, go back to something that Ken talked about, which is central bank independence. Unsurprisingly, I'm a believer in central bank independence. But it really is just an institutional arrangement that exists because the elected government allows it to exist, and as long as it serves the public well, it's a fine institutional arrangement. And I think it's easy to forget that we have this precious independence. It should be very, very rare in a functioning democracy that you have an institution that has the degree of independence that we have. Of course, we strive all the time to be democratically accountable and transparent. But I think that the temptation to wander into exciting new issues that really are the business of the elected government is a strong one and is to be resisted. And because I think that's, when I think of ways that independence could be undermined, to me, that's right at the top of the list.
Very good. Any other reactions or comments?
Well, I would just add to what Jay just said. I think many economists, particularly over the last 15 or 20 years, just take it for granted, and they have these very sterile technocratic models and don't realize that central bank independence is something central bankers have to fight for every day. It's a very political environment with which they have to protect their right to do monetary policy independently.
Very good. So let me open it up to the floor. So I'm going to start with Martin here. Please state your name and your affiliation, and then I'll move back and we'll alternate. So Martin, you go first.
So Martin Stürmer with the research department here at the IMF. Governor Yaron, thank you so much for joining us during these terrible times. I hope that you can live in peace very soon. Now, what are the scenarios that you are preparing for? What are the worst case scenarios that you're thinking about?
The projections that we gave, as I mentioned, were contained to a situation where most of the war is really at the southern border. It takes until the end of 2023. It doesn't mean there's no interactions in the war in the north, but there isn't a full-fledged transition into a war there. That's a different ball game. It will have a different impact. There's enough uncertainties even around just the issues of the southern border, just dealing with the southern border, how comfortable people will be coming back to some of the activities around there. The north border will be, if that happens, and we all hope that doesn't happen, this could have a much bigger implication. Is just a different scenario altogether.
Thank you. I'm going to go to the back, the lady over there. It should be working.
Hi, I'm Vivian. I'm an economist here at the IMF. My question would be to Mr. Powell. I wanted to hear your thoughts on a subject that Gita touched upon, which is the recent movements in the yield curve in these last many weeks. And I wanted to know if you think it's a change in natural rates, so maybe Fed funds rates should be a bit higher, or this is just a steeper yield curve, like higher term premium, so maybe Fed funds rates could be lower. And also, I'm a bit worried about over-tightening on a personal level, of course. So what would be clear evidence for you that rates are in restrictive territory enough, given the lags? I mean, we could be over-tightening. That's it.
Thank you. So on your first question, on the implications of higher rates, it's when we move the federal funds rate around, the real point is to affect broader financial conditions, and broader financial conditions then affect the economy, the real economy, in ways that we broadly understand. But so we don't target any one financial condition. We look at broader financial conditions. So it's very hard to draw a direct line from one particular thing like higher bond yields to what monetary policy should do. So the first thing you would look at, though, is you'd look for persistent changes. Even then, and so then the question is, and Gita touched on this appropriately, which is why are longer run rates going up? And it really, the reason they're going up really matters, so we have to factor that in. So it's something we're looking at. We're certainly not going to ignore a significant tightening in financial conditions through that channel, but we don't have to decide. We're moving carefully now. We've moved very fast, and rates are now restrictive, and so we're going to be looking at this question, and not something we're trying to make a decision on right now. In terms of, I take your question to be, why are long rates higher? I think there are many candidate explanations, and 5 or 6 of them, it's easy to get to a half dozen explanations. I think we really don't know. I think one thing to point out, though, is people are experiencing these higher rates are actually affecting people's mortgages. The costs of all their floating rate debt is being affected. So it's having an effect on the economy. You know that the standard thinking has been that this was largely about term premium. Then the question is, why term premium? I don't want to try to dive into all of that today, but it's something we're looking at carefully and just seeing. In terms of you mentioned over tightening, but how are we thinking? So I would just go back at the beginning. Really, the question was to move as fast as we could. As I went through with the chronology, In early 2022, it became obvious that we needed to tighten policy as quickly as we could, and also at a reasonable pace. So we did, and that was the main thing, was speed. The second question was going to be how high to go, and we're still on that question. We're still on the question of a policy stance that's sufficiently restrictive to bring inflation down to 2% over time. The next question will be how long to keep rates restrictive. And so we're looking at, there is no magic to it. We're looking at the incoming data, of course, but really we're looking at the implications for the outlook. It's really what are we learning about the outlook, the balance of risks, and all those things. And we're trying to make a judgment at this point whether we need to do more. And as I said, we did move very quickly. The speed is no longer, the main thing. The main thing now is to try to get to that right level. Of course, we don't want to go too far, but at the same time, we know the biggest mistake we could make would be to fail to get inflation under control. So that's not going to happen. We will keep at this until we succeed. So moving carefully and looking at all the evidence and trying to make smart decisions on behalf of the public.
You're listening to Fed Chair Jay Powell, along with others. He's in a panel discussion at the IMF's annual research conference in Washington, along with Geeta Gopinath from the IMF, the Bank of Israel governor, and also Kenneth Rogoff, chair of the International Economics Institute at Harvard University. Let's go back to Washington, D.C.
2020, fiscal policy and monetary policy were in line. And now they seem to be at cross purposes. That is, we have very easy fiscal policy here and presumably in Israel. Does that mean that the real rate of interest that you should aim for should be a little higher?
Amir,
do you want to go first? I think this situation, I'm not sure we're in a different situation right now in the U.S., so I think, the job of the government in this kind of an emergency war situation is to supply the needs of many of the people who've gotten hurt from the war, and to try to minimize as much the damage that might be from this event, and that require fiscal spending. There's also, obviously, as Ken mentioned, there's likely to be more military spending over time. And the point that I was alluding to was that we need to find the right balance where, on the one hand, these spending be done, and at the same time go and very carefully find less needed, or especially given the circumstances, items in the budget, and direct them into those spending avenues, such that the fiscal stand over time, and we've demonstrated very responsible fiscal position, and I believe that if we do that, while the debt to GDP of Israel will go up for a while, the fiscal position will retrieve back and fundamentally can avoid structurally changing. But that require to do these appropriate adjustments over time that I mentioned.
So first, the thing to say is that we stay very far away from commenting on fiscal policy, even indirectly. So I won't do that. But I will say the way I'm thinking about this is let's look at where real rates are. So the federal funds rate's at 5.3 and change. If you take a 1 year forward look at inflation, maybe that's 3. So you've got real rates that are above 2%, and that's well above most mainstream estimates of where the neutral rate might be. I think that our star is as a not a particularly useful way to think about policy, because it can be affected by so many things, and it changes over the short run and the long run. So I think I tend to look at it that we're in the range, we're in the place where we have restrictive policy, and probably significantly restrictive policy, and we're watching the effect carefully on the economy. I think the question of, has the neutral rate risen or will it rise, and will that be because of this factor or that factor, is less interesting given the policy job that we have to do. Of course, we have all the models and we look at them and things like that, but really I think about it in a more practical way.
Final question, sir.
Dr. Mamadouba from Howard University and Athletic International University in Hawaii. Actually, the biggest problem in the world economy is inflation. Why the Fed did not change its fundamental goal from unemployment to inflation? If you understand.
I'm sorry, could you repeat that?
Yes, actually the fundamental goal, the biggest problem in the world economy is inflation. Why the Fed, your bank, did not change its fundamental goal from unemployment to inflation like the ECB?
Great, thank you. So we have a congressionally set mandate of maximum employment and price stability, and those two goals are equal under the law, and we can't change them. Only Congress can do that. We do have a provision. The question is, what if we're very far from one of those goals and not so far from the other? And what we do is when we say this in our constitutional document that we've written, it's not a matter of law, but our policy would be to focus on the one where we're farther away from the actual goal. So 2% inflation, we were a year or so ago very far from 2% inflation, and that has been our focus. As inflation comes back down, it becomes more of an equal weighting thing. And when you're equally far away from each goal, then the two are equal because they are exactly equal under the law.
Thank you. So I want to thank our panelists, but I would like to give a chance to Ken to maybe have a final word, since this is this whole thing is for you. So
I think people were pretty interested in hearing everybody else on this particular panel. I will say on this last question about fiscal dominance, it's a very different thing when you're at war and fiscal spending's taking up, I don't know the number, but half of GDP suddenly. Defense spending's taking up half of GDP suddenly, and there's no country which looks at its inflation targeting framework exactly there. Nobody does that. I don't think anyone fully did that even in the pandemic. You don't have to comment, but I mean that had a certain warlike feel at the beginning. It's a very different situation where you really need to reach into the toolkit because the national objectives are now very different than just unemployment and inflation.
So please join me and let's thank all our panelists today.
Well, there you have it. From Washington, D.C., Fed Chair Jay Powell's panel discussion at the IMF's annual research conference in Washington, joined by the IMF's Gita Gopinath, Bank of Israel Governor Amir Yaron, and Kenneth Rogoff, who you just heard from just now, chair of the International Economics and Policy Institute at Harvard University. The S&P 500 down close to 0.8%. We're off of session lows, but noticeably lower since Jay Powell started speaking. Some highlights from Jay Powell's presentation just in the last hour, saying that monetary policy is working in ways we think it should, that some households and businesses are not feeling higher rates. He said that in the context of people with mortgages who are, sub 4% right now, and they're not tapping their home for equity. They're not going to taking out new mortgages. So it makes sense that they're not necessarily feeling those, 7.5% interest rates. I should say that it's Tim Stenovec on Bloomberg Business Week, joined right now by the host of the Masters in Business show on Bloomberg Radio at 10 a.m. Saturday mornings, and the chairman and CIO at Ritholtz Wealth Management, none other than Barry Ritholtz, in for Carol Master this afternoon. Hey, Barry.
Yeah, so it's kind of interesting to hear him say people are not necessarily feeling it. They're not putting the houses up for sale. That's why we have a giant inventory shortfall. It's been pressuring real estate in a lot of ways. I will say that municipal bonds and other forms of higher yielding tax equivalent forms of fixed income is attracting interest amongst at least the wealthier people in the country because, hey, if the 10-year is 4.5%, 5%, and you could get a triple tax-free muni bond if you're in New York, California, Connecticut, Michigan, a high tax state, you're getting the tax equivalent of 7, 8, 9%. They are feeling those yields, and if you have capital, you don't mind it that much. If you're a borrower, you really are not happy with
Yeah, especially those first-time home buyers who are finding that out of reach. Hey, let's head over to Charlie Pellet to give us an update on all the business news and the way that markets are moving. Hey, Charlie.
Well, hello there, Tim. We've got just about 27 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ very much in the red. Treasuries tumbled after one of the worst 30-year bond auctions of the past decade, along with those hawkish comments on interest rates by Fed Chair Jay Powell. You heard him live on Bloomberg Radio. So here's where we stand. S&P 500 index down 35 right now, down 0.8%. The S&P is at 43.47. The Dow lower by 236 points, down now by 0.7%. And the Nasdaq Composite Index is down 129 points for Nasdaq. That is a drop right now of just about 1%. 10-year yield 4.63% with a 2-year 5.03% right now. Spot gold up $8 the ounce to $19.58, higher by 0.4%. And West Texas Intermediate crude now up 0.3%. 75.56 a barrel. So what is it that has been driving sentiment? Joanne Feeney is a partner at Advisors Capital Management.
As we'd like to say in some areas of life, what have you done for me lately? In stocks, it's what are you going to do for me in the future? And so it turns out it's all about guidance. And we're seeing investors now look forward to 2024. And with the economic data coming in a little bit better than expected, maybe we're not going to see interest rates stay as high for as long. I think that's a little bit of a misread of what the Fed is up to, but I think that's where investors are in the market.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcast. Tesla shares are lower as HSBC initiated coverage on the EV maker's stock with a recommendation of reduce, citing the timing of delivery as its primary concern. Today, we're looking at Tesla shares down now by 6%. So again, recapping, equities lower, just about the worst level of the day right now on the S&P, down 34, down 0.8%. 10-year yield 4.63%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. So we did see significant moves, not just in the equity market, but also in the bond market in the wake of Fed Chair Jay Powell's commentary in Washington just in the last hour, 90 minutes or so. Tim Stenevec and Barry Ritholtz in for Carol Masser this afternoon. It is Bloomberg Business Week. I want to bring in right now Molly Smith. She's economics editor here at Bloomberg News. She was glued to her Bloomberg terminal for the last 90 minutes or so, give or take 5 when they kind of had to go away because of those climate protesters in the beginning, which I think is starting, Molly, to become like a signature element of Powell's conversations.
You know what it also reminded me of, Tim, because I'm so glad you brought this up. Who else was thinking Coco Gauff semifinal at the U.S. Open?
That's right.
Nearly an hour disruption there, though. So at least Powell has only been a couple minutes.
2 times in a row at this point.
2 in a row, yeah. That was only a couple weeks ago at the Economic Club of New York discussion. So definitely whatever event he's got next, security is going to be tight.
So what do you make of the comments that he made? Because we certainly saw big market moves as a result of them.
Yeah, I think there was a bit of work that he had to do maybe to rein in some of the rally that we saw last week, that maybe financial conditions had loosened a bit too much, and that he wants to, keep markets on alert here that maybe we are probably done, but there still is a chance that there could be another hike, and don't get ahead of yourselves that this is like a done deal at this point. So I think he was just really more strongly maintaining that optionality today.
So Molly, I have a question for you about the 2% inflation target. I've done a lot of research on it. I can't figure out why they're so obsessed with 2%. There's no academic research. There's no data that suggests this is an important number. Former Fed Vice Chair Roger Ferguson essentially says it's a made-up number from New Zealand.
But we're sticking to it.
So what's the appeal of 2%?
I mean, it's what it has been. It's what it still is. Fed policymakers will tell you that several other advanced economies also target at or around 2% inflation. And the big thing for them is that you can't move the goalpost in the middle of the fight. That would just be admitting that you lost, that you have completely no control over where this is going, and you're giving up defeat halfway through it. And that would really, at a time when their credibility is already in jeopardy, not help.
I hate that narrative. I hate that excuse, because we were at 2% when we were in a period of monetary stimulus where we could not get rates above 2%. Now we've had a regime change. We're in a period of fiscal stimulus, and instead of looking up at 2% from below, we're looking down from higher rates. 2% is, to be consistent just for the sake of consistency seems like a bad policy.
Yeah, I mean, I think a lot of people will tell you, too, that today's economy is structurally so much different than the economies in the past from when 2% inflation was a more appropriate target, that there are now forces that, are supporting inflation being at a higher, longer neutral rate. And that's the whole point of what higher for longer really is, right? I mean, a lot of that is obviously the posture of interest rates, but it's also the posture that keeps inflation at a steady level. And the steady level, I think a lot of people, to your point, Barry, would argue that's more in the neighborhood of 2.5% or 3% rather than 2%.
Right. The post-financial crisis economy, much weaker than the post-COVID fiscal stimulus economy.
So I want to pose this question to Molly, and then Barry, feel free to jump in, because this is kind of a question for both of you. But Molly, in the last few weeks, we heard a lot about Fed speakers, Fed watchers saying, okay, the bond market is doing a lot of the work for the Fed. And we even, heard that from voting members of the Fed. Then over the last week, we saw bond yields come down significantly. We saw equity markets move higher. We saw financial conditions loosen. And I think to myself, wait a second, is the Fed shooting themselves in the foot saying, we're not going to make policy more restrictive in the future because the bond market is doing our job? So then we see these big moves in the bond market stops doing the Federal Reserve's job.
Isn't it fun how that works?
I mean, come on. Obviously that's going to happen.
I think, what you have to keep in mind, too, is that, Powell does not dictate what happens on Wall Street. I think they will tell you that they're more concerned of affecting the Main Street economy. I mean, sure, yeah. And even though that, there has been that rally in in Treasury yields over the past week, you're still right now looking at a 10-year yield that's around 4.64 and change, compared to I don't know, earlier this year in the 3.5 area. That's
and just a few weeks ago, close to 5.
Exactly. So, I mean, I think there's still a lot of work has been done by these yields, but they also just can't let this really get out of control, because that would then risk an even bigger problem.
So Molly, you're the Fed expert.
You too, Barry. I mean, feel free to take some.
I'm a jack of all trades. You focus on the central bank. How do you tell the difference between when they're trying to jawbone markets and actual policy? Because sometimes, to me, the whole concept of a hawkish pause, either you're raising rates, lowering rates, or leaving them the same. It's like jumbo shrimp or military intelligence, the old George Carlin routine. There's no such thing as a hawkish pause. Either you're tightening or loosening. But that said, do they really rely on jawboning to let the market do some of the heavy lifting for them?
I mean, it's tough to say. I mean, I think for me, that was really the central question in terms of the statement that we got at last week's meeting. Was it last week? Yeah, that was
last week's meeting.
Okay,
I know these weeks.
It was about 6 months ago, or 7 days. November 1st. It was years ago.
Age you.
Right.
So anyway, but yeah, it was last week. But that statement, the only big difference between that one and September was the nod to financial conditions. Otherwise, they were practically identical. So that also, to your point, made me wonder, are they saying this because they are really actually worried about what's going on with Treasury yields, or is this some way to actually affect policy? So I think, I'm still wondering that myself.
Did anything surprise you? I mean, did we hear anything new from Fed Chair Jay Powell today?
No, I think it was, some of the comments in the phrasing was more or less identical to what he said in, recent weeks, particularly they're not confident that they've reached the stance yet to achieve 2% inflation. That's a line he said many times before. I think it was really just more maybe flipping the tone to say we might have to hike again, but, we're close, versus we're close, but we may have to hike again. I think it was honestly just, changing those two clauses to lead with, we still may have to hike again.
The thing that shocks me about the Fed and Wall Street, say what you will about Jerome Powell. He has said, this is what we're going to do. And then he went out and did it. And the whole time, it looks like the street just never believed him. He's been pretty transparent and does what he says he's going to do. I don't know why traders don't seem to take him at his word.
I also think it's worth... Go ahead, Molly.
No, I completely agree. I think it's like, I don't really know what more people want to see from him in terms of transparency. I mean, the guy's got, I would say, one of the toughest jobs in the world right now. And I think he's giving himself a pretty good roadmap of like, we're going to take it as it comes and see what we're going to do.
Also, lest we forget what happened during the Trump administration and the way that, Jay Powell was just bullied by President Trump for raising rates before the pandemic came along and he had to cut rates. I mean, this is a guy who has been through quite a lot. I mean, a pandemic, inflation, and then, hearing a lot from President Trump about not wanting him to raise rates.
That's why Twitter has a mute button. You could just mute that. And, it's certainly no fun when the President of the United States brings the full weight of the office to pressure you. There has been a history of previous presidents literally cornering Fed chairs in cloakrooms and saying, dude, you're killing me. You gotta loosen up a little bit. But this really took it to a next level. I think of Powell as a moderate Republican. I think he has to be kind of relieved that Joe Biden is, hey, we respect the independence of the Fed and you're not going to get harangued by us.
It's certainly politically a difference from the last administration.
Very much so.
Yeah, and he didn't miss that in saying today a couple times, it's no surprise that I value central bank independence. So, I think he certainly likes to know that the White House is and the other comments in the peanut gallery, keeping it to a minimum.
That said, he isn't afraid to call on policymakers to make policy where the Fed, doesn't control things outside of its dual mandate. Certainly.
Well, we've talked about fiscal stimulus earlier, but for a long time, people ignored the deficit. It was just not a hot topic. And we missed the opportunity to refinance a lot of debt at much lower yields. And we're coming up on $1 trillion a year just in interest payments. So clearly the Fed is going to be involved in those conversations.
Molly, I want to give you the last word here.
Yeah. Well, let's see. I mean,
I made her speechless. The last word is speechless.
I'm speechless. I mean, I think this was honestly a lot of just like kind of reining in the rally of the last week. I think that was more or less the objective today. And if it was, mission accomplished. But that said, somebody could come out and from the Fed and say something else tomorrow and we could see a whole other different move. So yeah, I think right now the trading is pretty fickle, but Powell's trying to dictate the narrative as best he can.
All right, the NASDAQ down 1.05%, the S&P 500 down 0.9%, the Dow down 0.7%. That's Molly Smith. She's economics editor here at Bloomberg News. Also in for Carol Master this afternoon, we have Barry Ritholtz, chairman and CIO at Ritholtz Wealth Management and the host of Masters in Business on Bloomberg Radio. You're listening to Bloomberg Business Week. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, well, it's hard to believe it is that time already. We are just about 14 minutes away from the close of U.S. trading here. As I mentioned, the NASDAQ is in the red, down about 1%. The S&P 500 down close to 0.9%. The Dow down 0.7%. It's time for us to drive to the close. We got Nancy Tangler, Chief Investment Officer at Laffert Tangler Investments. She joins us on Zoom from Arizona this afternoon. Nancy, we should note, also the author of The Women's Guide to Successful Investing. It's good to have you back with us, Nancy. How are you?
I'm good, Tim. How are you? Thanks so much for shouting out the book.
Yeah, of course. We're doing pretty well here. So I wanted just to get your thoughts before we get to your bigger macro thoughts about what's going on. Just give us your reaction to what we heard from Jay Powell over the last 90 minutes or so.
Yeah, I listened to the previous segment, and that's a smarter crowd than I am. I've been really actually disappointed with the Fed's rhetoric from the get-go. I mean, let's not forget, this is the third bear market that Jay Powell has presided over. The first one was when he spooked the markets in October of 2018. He doesn't get credit for the COVID one, nor blame at bear market. And then we had, last year. And so it just astonishes me that the market sort of, breathes a sigh of relief when they're dovish, and then the next day someone comes out hawkish, and we get this, the same kind of reaction. And yet, at every turning point, not only has the dot plot been wrong, but a lot of the chairman's policies have been wrong, and things that he has said at one point turn out not. I'm not even thinking about raising rates. It won't be 75 basis points. It's 75 basis points. It's transitory. This data-dependent Fed, I think, has created a lot of problems that we could have avoided. So he may be being transparent, but I don't know why the market continues to react to every morsel that comes out of this committee and the Fed chairman.
Nancy, Barry Ritholtz here. It was transitory. Transitory just took much longer than any of us expected.
Isn't everything transitory?
Right?
Barry?
I mean, in the long run, it's that's the Keynes quote. In the long run, we're all transitory.
Exactly.
But really, I think I take your criticism as they have been late every step of the way. They were late to get off their emergency footing. They were late to recognize inflation. They were late to begin raising, and now it feels like they're going to be late to recognize that they're done and could tip us into a recession. Is that your criticism, or what is it specifically?
It is that, I think, Barry. And, I look at this market as an analog to the 1990s. I was managing money then. Not only was I alive, but I was managing money. And there's a lot of similarities. But in this environment, the Fed's backward-looking focus on data, I mean, we can't do that as portfolio managers. We can't say, earnings were good last quarter and then extrapolate that out to infinity necessarily. I mean, we have to be looking at everything that's coming down the pike, and I don't think they're doing that. I mean, one of the things that I think they could be paying closer attention to is some of the inventory data. We've seen a real surge in inventory. If you look at the S&P, and this is Brian Reynolds' work, not mine, you look at the S&P 500, median days of inventory has shot up to 78 and a half days, up 21% in 3 years. So if you have that kind of inventory, inventory turnover is slowed, I think you have to anticipate that that's going to be at the very least disinflationary. And yet we're hearing these, responses to one day of data backward looking. I mean, God forbid we get a bad CPI number, because who knows what we're going to see next week. But I think it's they've created volatility. Powell's unwillingness to kind of at least go to Congress and say, hey guys, why don't you stop spending? I mean, he's only half of the equation, right? And yet there's no mention. It's not our business, but Volcker did it. Greenspan did it. And I think there needs to be some acknowledgement that the spending is really keeping inflation sticky.
Really fascinating.
Nancy, I want to get your thoughts and just transition a little to where you see opportunities. So move from the macro to the micro a little. You've got some really interesting companies that you're keeping an eye on that you think are doing really great work. I want to start with Starbucks right now. It's a company that's gone through a transition. I think it's fair to say. It's a company that wants to, make a lot more coffee in a lot more places, even though it feels like wherever you go, there is a Starbucks already. Talk to us a little about why you're seeing there a lot of opportunity with Starbucks right now.
Cheers. I just had a sip. I think Laxman is, and by the way, I'm going to call him Laxman because I haven't quite mastered his last name yet, but I think he has a lot of levers to pull. He understands that. He's come in, set reasonable expectations, and he's delivered on them. And that's always tough for a new CEO, especially in the shadow of Howard Schultz. But, interestingly, I write about that in the book because I actually first bought it for myself in 2007 after Schultz had left and they kind of saturated the market. And
left the first time.
Yeah, 45.
Okay.
That's right. Okay. 45 to 30. And I thought I was a genius because it immediately went up like 20%. And then we got the great financial crisis and the stock traded down to 7. And I should have bought more. I didn't, but I did hold on. And since then, the stock's returned about 14% annualized versus the S&P around 8.5 annualized since 2007. So it is a great company that has a history of being able to turn the corner. I think the the China story is going to be critical. They actually saw some pretty decent growth in China. They fit one of our themes, which is old economy companies that are embracing digitization. They've got 75 million users, digital users, and that really drives margins. And they are really focused. The labor problems have improved somewhat, and they are really focused on innovation and margin improvement. And I think from here, the stock has an opportunity to be, once again, a great growth company.
So not a surprise that the stock got shellacked during the lockdown period when people couldn't get to their local Starbucks. But we've really only recovered about half of that drop from, let's call it $1.25 to 75. We're now a little over 100. What's it going to take for Starbucks to clear that prior high and start trending upwards on a consistent basis again?
Yeah, and by the way, we got out, I think, right before COVID because it just got too expensive for us, and then dipped back in. I think they've got to be able to prove that they can grow in China in a sustainable fashion. They have to improve delivery times and product innovation. And I think, and then the labor question, it was like the, a triple threat. You had China breaking down, you had COVID, and then you had labor problems. And I think if he can smooth those edges, I think the company, he's talking about 15 to 20% earnings growth. And I think they can get there. I mean, at some point if goes away, right? I mean, I just paid $7.50 for the Starbucks.
Wow.
I'd rather have a Chipotle burrito. If I'm
where can you find a Chipotle burrito for $7.50? That's what I want to know. That's what I want. That's half a Chipotle burrito for me.
Right. Chipotle, though, is going to be 3 times the size of whatever you're getting from Starbucks.
That's a good point.
What's the next innovation? What's the next pumpkin spice latte that's going to drive sales for them?
Yeah, well, I mean, that's the question, right? I'm going to leave that to them. But they have the cream cheese latte in China. So cream cheesecake, I think, is what they call it. So who knows? But I do think that the cold brew pivot really, and cold drinks in general, has really driven growth. And they have to solve the in-store question as well and increase drive-throughs, which is really what Chipotlanes did for Chipotle. Even though Starbucks is ahead of Chipotle on that particular metric, they really need to just keep these smaller stores driving through, because the sitting around and becoming a community Starbucks is a bit of a thing of the past.
And I'm going to assume you're not buying into the whole Ozempic is killing Starbucks, Doritos, and McDonald's theme, or is there anything there?
I don't really think there is. I mean, in the 90s, we had fen-phen and people stopped eating for a while. But, I understand that this is a lifestyle drug too. But a lot of the people that I know that are on it are people that had gastric bypasses and then managed to gain the weight back anyway. Huh. So I think those old habits die hard. We own Pepsi. I start my day with a handful of Cheetos every day.
Is that the secret, Nancy? The breakfast of champions? I've never heard that.
It is so good. In fact, at my firm, they call them Nancy Tanglers because I
orange dust all over the laptop. All
That's
over
right.
login.
Hey, Nancy, before we let you go, just want to get some 30 seconds on Amazon right now. Andy Jassy, inheriting this company, I think it's fair to say, from Bezos, and it's been a challenge there. Why are you bullish on Amazon?
I think Andy Jassy got Tim cooked. And we bought Apple in 2013. We still own some, but we've been forced to sell much of it because of the valuation. But I think he had a lot of challenges that he has delivered on. He laid people off. He improved growth in cloud at the expense of Google, it would seem, or Microsoft was the one that really took share, which is our largest holding. But I like all of the aspects of the business. And we sold CVS because we just couldn't wrap our head around the model a while ago. I just shifted the few prescriptions that I utilize to Amazon. It is a dream. And I think they're going to start to take share not only in pharmaceuticals, but in the healthcare space to some extent. So, the retail business, we know that business. It doesn't have great margins.
Yeah.
The cloud business is still performing. They're employing AI. They're generating revenues from advertising. And I think he's gotten a rhythm as the CEO. The last call was pretty darn good.
Nancy, we're going to have to leave it there. Really appreciate you taking the time this afternoon. That's Nancy Tangler, Chief Investment Officer at Laffer Tangler Investments. She joins us on Zoom this afternoon from Arizona. Nancy's also the author of The Women's Guide to Successful Investing. We are just a couple of minutes away from the close. Here we're seeing right across the screen, the Dow down 0.7, the S&P down 0.8, and the NASDAQ down 0.9. Coming up right now, it's our countdown to the close with our Bloomberg TV cross-platform coverage. It starts right now.
We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Tim Stenovic and a very special guest, Barry Ritholtz, sitting in today for Carol Master. Welcome to our audiences across our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Tim?
I thought stocks only went up. But I guess that, you know, when you hear from Fed Chair Jay Powell, nothing new, then, you know, sometimes stocks go down, you know. The Fed chair is saying, okay, well, we're still, you know, not to 2%, but we're wedded to 2%. And we could still see some more tightening in the future.
Yeah, I thought it was kind of funny that we've been heading straight down since August, and we have a 8 or 9 day rally, and suddenly the Fed is nervous that animal spirits have been unleashed again.
Seemed like the market kind of wanted to be down today. I hate going to lame explanations like that, but after an 8-day rally, you need a reason to continue rising, and you didn't get any reasons to continue rising, so this is the default scenario.
A default scenario that claws back just some of the gains here, but is that trend line, is it still up? I mean, because I think that's really what people want to know, right? You look at the long-term trend lines, and if you can make a case here that there is a longer-term story, then maybe you get more comfortable with that volatility, with the idea here. But it's funny, as we're speaking, guys, we're showing the Russell 2000, and that's been the big laggard. I mean, we talk about that 8-day rally, but that was an 8-day rally that was still kind of centered around the larger cap names, and more importantly, some of those tech names.
Yeah, and since mid-September, the Russell 2000 has lost about 9.2% versus just a 3% odds slide in the S&P 500.
All right, well, after an 8-day run for the S&P and a 9-day run for the NASDAQ, we're seeing red across the screen for all of the major indices here in the United States of America. The Dow Jones Industrial Average down 0.6% here on the day, roughly 200 points lower than where it was yesterday. The S&P 500 is going to close down by about 35 points, or about 0.8%, right around that 4,347 level, while the NASDAQ down about 128 points, or 0.9%. And we just mentioned it there. The Russell 2000 remains the laggard once again here, down 27 points or so on the day. That's about 1.6% lower.
All right, peeling back the layers of the S&P 500. Not every stock is lower. We've got about 125 stocks at this point that did move higher today. Scarlett, 378 did move to the downside.
Yeah, but most industry groups are definitely in the red. You have 24 of them, and we have 3 that are gaining, but it's just barely. Insurance companies, household and personal products, and semiconductor companies barely in the green. On the downside, Tesla leading autos and components lower by more than 5%. Pharma stocks also losing 2.8%, and REITs under by 1.5%.
All right, well, I did manage to find some stocks in the green today, some barely hanging on there. Got to talk Disney right now, up by 6.87% on the day today. Disney shares rising after the company reported better than expected profit.
Doesn't that mean their costs are now going to go up? I thought all the cost savings were because they weren't actually making anything.
Okay, yeah, but then you got to create content for people to go pay for Disney Plus and then go watch in movie theaters. Yeah. Although not many people, I haven't heard great things about the newest Marvel movie out there.
Oh, the Marvels?
Yeah, I haven't heard great things. Yeah. Let's talk about NVIDIA.
I feel like they're just running out of ideas because usually it's like individual movies. Now it's just the Marvels, right?
Yeah, that's the new one. Yeah, it's just all the characters.
I think they should just come out with a new movie called Comic Book. How about that?
Just team up with with DC for that one, right? NVIDIA shares finishing the day higher by 0.8%, holding on to those gains after a report said that the company has completed designs of 3 new AI chips for China. NVIDIA now up for 8 consecutive sessions of gains. Is that right? Its longest winning streak since March. Look at that. And then Virgin Galactic shares SPCE. Okay, before we talk about today's gain of close to 20%, of 19.2%, we should note that shares are down about 47% so far this year. The company did come out and say that it was boosting its revenue forecast for the fourth quarter. It delivered third quarter revenue that was ahead of consensus, also slashing 18% of its workforce, pausing space flights starting in mid next year. They're going to cut costs and focus on developing new launch vehicles. Shares of Virgin Galactic higher by more than 19% today.
All right, let's take a look at some of the decliners. There are plenty to choose from, so I went with the biggest decliner in the S&P 500, Becton Dickinson, off by almost 1/10 of its market value. The biggest decliner in the S&P, as I mentioned, the medical device maker gave a 2024 full-year profit and sales forecast that trailed estimates in large part due to currency rates. Corteva slumping to a 2-year low. That's another big decliner today. The ag company posted a quarterly loss and sinking sales. It's losing pricing power, and I suspect this is something that we'll see more of from other companies. It says the growth in prices will slow to a low single-digit percentage increase next year. Pretty ugly chart there. And Bill, it tanked as much as 16% after denying reports that it's pursuing any M&A right now. We had reported yesterday that the company, which makes financial automation software to small cap companies, is in talks to buy a digital payment company, but that's not to say that it won't make the purchase at some point. It's just not happening right now.
All right, let's take a look at the yield space because, of course, that's where a lot of the activity was, at least on a settled basis right now. You're looking at the long end of the curve up about 16 basis points, the shorter end of the curve, your 2-year yield up about 11 basis points, and the 10-year up about 15 basis points. But that really kind of obscures the volatility that we saw. On the 30-year yield on an intraday basis, we saw a 22 basis point swing at one point on the day here. You have to go all the way back to mid-March, the last time we saw a swing like that on longer-term yields, and that was largely due because of the unraveling fallout from the regional bank crisis that was just kicking off. Of course, the big unraveling today, guys, came because of that Treasury auction. And I started off here talking with Scarlett when she joined us on set here. I think the big number of the day really is that number that we got out of that auction, which is 4.769% here. And the gap that we saw that bidders had to take versus what was actually traded in the market before, that demand, it just continues to dwindle.
Yeah, what we've been hearing about auctions has been pretty interesting. There's also a story about a hack from one of the primary dealers whose entire system kind of, stepped off of the normal process. That could have some sort of effect here as well.
Yeah, and that was a big deal. And I mean, it's funny because a lot of people were scratching their head, ICBC, and everyone was like, what is that here? I mean, this is actually the world's largest lender in the world, by assets at least. And they're a huge settlement shop for a lot of folks who are trading treasuries. So it's possible, it's certainly plausible that it could have had an effect. It might take some time before we get official confirmation.
But I guess the question is, if that is what moved the market lower when that auction happened, then why didn't we see when the news story came out that there was indeed some recovery? Was it what we heard from the Fed chair and about rate moves forward and that the Fed isn't done?
Yeah, well, think about the timeline. I mean, this happened early in the morning, right?
Yeah.
You did see some movement back in yields once that started to get resolved, or at least it started to become public. But then, of course, you had that auction. Then you had Jay Powell start talking, and I don't know. I'm sure somebody else said boo or somebody to something, and that's why we got what we got.
How does this set us up for next week when we get CPI? That's what I'm wondering.
Yeah. I mean, it's a big deal. I mean, look, aren't the economist estimates, Barry? And I mean, I don't want to get too deep in the weeds, but we talk about going back down to 3.1%, which is what economists are forecasting, I believe, for the CPI report next week. But, a year ago, we were at 9% or so here. And I know 3% isn't 2%, but shouldn't we be encouraged by this, Barry?
100%. And keep in mind, 3% isn't 2%. Unless you actually measure housing appropriately. And if you look at someone like Cam Harvey of Duke, who's crunched the numbers, his takeaway is that if you use apartmentlist.com or even Case-Shiller, you end up with an inflation number in CPI that's under 2% because the Fed is working on very stale data. Owner's equivalent rent is not up to date remotely. It's not an especially good measure of housing inflation. And hopefully the Fed is aware of how far behind the curve they are in recognizing inflation has fallen pretty close to their 2% number.
One thing that I've been thinking a lot about over the past few days is what we heard from Fed speakers over the last couple of weeks, Scarlett, which is that yields are doing a lot of the work for the Fed. But since we heard that from Fed officials, we've seen yields come down and stocks move higher. So what does it mean that the Fed came out and said this, but in fact, the yields are not doing the Fed's job anymore? It seems like a kind of a dangerous little cycle.
The Fed's saying that turned the whole trend around, right?
Exactly.
I think
maybe they shouldn't have acknowledged it.
Just pretend it didn't happen. Omar Aguilar, who was just with us, was telling us of Schwab that 2/3 of the moves in equities can be tied directly to bond yields, which is pretty remarkable. Forget fundamentals, forget earnings. Day in and day out, the swings are dictated by what happens in the 10-year or the 30-year.
All right, guys, that is going to do it for our cross-platform coverage this afternoon. Thanks for welcoming us so warmly. That's beyond
I like
the
that
bell.
Barry guy. You should keep him around.
We are going to keep him around. He's going to hang out with us for the next couple of hours. Check us out tomorrow, same time, same place. We're on Bloomberg Originals. We're on Bloomberg TV. We're on radio. And, of course, we're on YouTube.
Problems, problems, problems all day long.
Well, until today, we had seen quite a rally in equities over the last 10. As of earlier today, when I wrote this, I should note, stocks were up a whopping 6.5% since October 27th. Our next guest, though, says that the strength of the mega cap stocks is painting a false picture of the health of the market and expects a recession to begin in the next few months. We're very pleased with us. Well, we're not so pleased with us, but I'm very pleased with Doug Ramsey, our next guest. He's CIO at the Luthold Group. He joins us live in the Bloomberg Interactive Brokers studio. Doug, good to have you with us. I got to tell you, I got a text from a friend this morning. We sometimes talk about investing, and he likes to send me articles. I like to send him articles, and he sent me an article that had a headline that I've been hearing over and over from guests, which is like, okay, enough with the S&P 500. Focus on the S&P 493, because the 7 stocks that are responsible for so many of the moves that we've seen this year are getting way too much attention.
They sure are. I mean, all year they've painted this false picture of the market's internal strength, and that bothers me, especially with respect to the narrative that we've been in a new bull market for the last 13 months. If we were in a new bull market, and there's always a chance, but you'd expect to see the average stock trumping the relative safety of the broad cap-weighted averages. You'd expect to see the Russell 2000 up 50 or 60% from its lows, and it's hovering here after the setback we've had the last few days here, 2 or 3% above its bear market lows. It's just not bull market action, and I think, the smaller stocks are more credit sensitive, so it stands to reason they would start to respond to the tightening in financial conditions first.
So here's the pushback to the criticism, and I'm going to play a little devil's advocate here. Hey, the Magnificent Seven, as people like to call them, $1.8 trillion in revenue, $250 billion in profits. They're best positioned to put AI into place, and this is the biggest, I don't know, call it a super cycle, a platform, whatever buzzy word Silicon Valley likes these days. It's the next internet. How do we contextualize those, Microsoft and Apple and Google and Facebook, those companies' ability to use this new technology and profit from it?
As businesses, I think the bulk of them are going to do fine. I mean, the issue is they may have to grow into their price tags. And I mean, unlike 2000, I mean, these are much comparably bubbly valuations, but much bigger companies. So just, the law of large numbers is going to hit them more so even than it did like a Cisco back in 2000. So I think they're going to do fine as businesses. And if we have a recession, it may even buttress their businesses like it did during the shutdown 3.5 years ago. And I think, so there's sort of some reflexive buying of those stocks and owning of those stocks because of that memory of how well they did during the shutdown.
You're saying they're the new safe blue chips?
Yeah, exactly. When you look at, the behavior of consumer staples, obviously a lot of that is the Ozempic effect. But yeah, I think there's sort of a surrogate for cash for these big portfolio managers that must remain fully invested
What are your concerns about the economy? What leads you to think that we're going to hit a recession in the next few months?
I'd love to say it was some penetrating statistic deep in the Federal Reserve archives, or different ways of looking at liquidity, but it is really the traditional stuff.
Like meaning a recession is a natural part of a business cycle?
The yield curve inversion, and both it's, people tend to say, they tend to look at the yield curve in a binary way. If it's inverted, bad. If it's uninverted, good. But it's the depth of this yield curve inversion. As a matter of fact, it's sort of re-inverted. After a lot of uninversion, a lot of moving towards zero, it's sort of re-steepened again. But I just think every day that negative spread between tens, and we like to look at the 10-year minus the 3-month. We also like to look at the near-term forward spread, both extremely deeply inverted. That is just hitting the economy every day, and it clearly it's hitting the mid and the small cap stocks, and even the equal weighted S&P 500 down on the year.
Barry, what do you think of that? Can we ignore that inversion?
So it's, I agree that it's not just, I agree with Doug, it's not just the depth, it's the depth and the duration.
Yeah.
We've been inverted for a long time, although if you look at the academic research, the recession happens once the inversion unwinds, and then I think it's about 150 days after.
But there's also a mixed record. The last recession that we had at this point was during the coronavirus pandemic, and there was an inversion in the yield curve before that, but that recession was completely unrelated to.
Well, we don't know what would have happened without the coronavirus. The problem with the yield curve, the two big problems with the yield curve inversion as an economic indicator. One is it's been 8 for 8, which is perfect, but 8 is a very small sample set. And when we go out of sample, when we look at Europe, it's much less a reliable forecaster. Now, different economies, different sociology there. People tend to stress much less because, hey, they have health care. If there's a recession and they get laid off, they don't care, nationalize health care. So maybe that's why it doesn't work there. I'm just, spitballing a little bit. But it's kind of tough to look at. Is the yield curve an indicator of recession, or does it, as Doug implied, cause a recession because of that inversion?
Yeah, and I'm in that camp, and I'm even in that camp. And now here's something I'd like to see confirm that, I should say, is a weaker stock market. Like right now, the stock market on a trailing 12-month basis is too strong for a business cycle top to occur right here. So we did this research. We basically asked, okay, what did the stock market do, S&P 500, do on a 12-month trailing real basis leading into the business cycle peak? And the answer is that on average, now excluding 2020, again, that was a different animal, but on average, the S&P 500 was down in real terms 10% at the previous 8 business cycle peaks. And it was flat or down every single time. And then I think it was up like 3-4% at the February 2020 business cycle peak. So I'm sort of saying the best thing the market's got going for
is the market.
Well, is the market and the economy. And so when we do get to where stocks are roughly flat to down year over year on a real basis, that will be the negative wealth effect that is sort of the final straw that breaks the camel's back.
Okay.
So,
go ahead,
the last thing I wanted to ask about is when we're looking at the economy, and I know these can just fall right off a cliff into a recession. GDP, all right, that's kind of a one-off number, just under 5%, 4.9. I think we all know this is really a 3% GDP economy, not a 5%. But unemployment has remained very low. We're pretty close
to...
Sub
4%.
Right? We're pretty close to 50-year lows. People have been getting wage gains. Inflation seems to be moderating dramatically.
I've heard the word. I didn't hear the word Goldilocks coming out of your mouth. But
well, the reason it's not Goldilocks is a combination of how unusual it is coming out of the pandemic, and then all of the geopolitical turmoil. How do you work that into your model?
Well, just a couple points. First with regard to the unemployment rate, this would be like the unoptimized version of the SOM rule.
Yep.
The unemployment rate has ticked up 0.5%. And that's always the old school rule of thumb, not the moving average calculation. But that's confirmed 8 of the 9 last recessions, not forecast them, confirmed. And as a matter of fact, in 4 of the 8 last recessions, that uptick of 0.5 point in the unemployment rate was the exact month of the business cycle top. And then 2 of the remaining 4, it lagged by 1 month. So if you were going to try to call around close to in real time the peak in the expansion, I would propose a 0.5 point increase in the unemployment rate has been a pretty darn good one.
3.4 to 3.9. There's your half point.
Yep.
We already
so
have it.
Yeah, it's happened. And then I think it'll happen with a 3-month moving average triggering the SOM rule next month.
We got to get you back soon to see where things are. Check the progress here. Doug Ramsey, CIO at the Luthold Group. He's with us here in the Bloomberg Interactive Brokers studio. A headline crossing the Bloomberg terminal, WWE founder Vince McMahon to sell about $700 million worth of TKO stock. You're listening to Bloomberg Business Week. Barry Ritholtz and Tim Stenevec live in the Bloomberg Interactive Brokers studios, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's
421 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ ended the day very much in the red. Treasury yields surged. Stocks finished lower as Jay Powell threw cold water on Wall Street's dovish wagers. 10-year yield 4.62%. Two-year yield 5.03%. The Dow, the S&P, NASDAQ all lower today. S&P was down by 35 points. Dow Jones Industrial Average down 230. NASDAQ was down 128 points. Again, 10-year yield 4.63%. Spot gold up $7.84 the ounce to $19.58, a gain of 0.4%, while West Texas Intermediate crude oil was up 0.3%, $75.58 for a barrel of WTI. Walt Disney rallied after earnings, up the most in a year. It did report better than expected profits and vowed to cut $2 billion in expenses. Disney today up 6.9%. ARM Holdings shares moved lower by 5.2% after the chipmaker gave a disappointing sales forecast amid a slump in smartphone sales and uncertain timing for new licensing deals. Again, recapping stocks lower. S&P 500 index today lower by 35 points, down 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, it's finally here, an end to the historic 118-day strike. But who's counting? That halted TV production, it delayed movie releases, it shut down much of the entertainment industry. Hollywood studios and the union representing some 160,000 actors have finally reached an agreement on a new 3-year contract. Remember, the writers who went on strike back in May have been back on the job for about a month. At the same time, we did see shares of Disney rallying. We heard that from Charlie Pellet after the company reported better than expected profit and vowed to cut $2 billion more in expenses. For an update on all things Hollywood, we turn to Thomas Buckley, entertainment reporter here at Bloomberg News. Tom joins us on Zoom from our LA bureau. Good to have you with us this afternoon. Give us the details of what we know, because there are still some details to be hashed out, which is my understanding, of what we know about this new deal that ended the actors' strike.
Absolutely. Well, great to be here. You were suggesting who's counting. We've very much all been counting over the past 118 days. For this to come to a resolution, it looks like we're very much there now. So late yesterday, the negotiating committee of the SAG-AFTRA union approved terms that were put to them by the studios and have recommended those to the board. There'll be a board meeting tomorrow to ratify the deal. And my understanding at the moment is that the increase in the terms of the overall deal add up to about $1 billion. So it's a very significant win on the actors' side, it looks like. They also sought very robust protections as it relates to the use of artificial intelligence concerning the actors' likeness. So more details of the deal will come out tomorrow once it's been ratified by the board at the meeting.
So, Thomas, you're saying this is a win for the actor side, but we see Disney stock up substantially in a down market. Obviously, this has to be a positive, and that's before we even start looking at Netflix or Apple or Amazon, anyone else with an interest in this. Why did this take so long to reach this agreement? Was this a win-win?
It's a very good question. I think it certainly is a win overall for the town. I mean, Hollywood has been desperate to get back to work ever since the writers walked off the job back in May, seeking better terms in their own contract. The DGA, which represents the directors, was able to get more favorable terms, and there was no need for a strike there, they argued. And then the actors themselves walked off the job in July. And since then, the vast majority of Hollywood productions, be they TV or film, if they're not independently produced, have been shut down. So that's impeded really a ton of titles from progressing over the summer and ended up imperiling much of the autumn season for TV and the blockbuster season as relates to theatrical films for next year. So I think there is an immense sigh of relief that everybody can now return to the job really as early as today, given that the strike on the actors' side ended at 12:01 last night. I think that the reason why we're also seeing Disney stock up is obviously that they had decent results yesterday, which is really driving a lot of the equity story there today.
Yeah, I want to talk more about Disney in just a few minutes, Thomas, but I want to make sure we hit every constituency here. So we just had Barry ask you about the companies. You talked about the workers. What about people like me who, after a long day at work, want to go home and stream something on Hulu, Netflix, or HBO. I guess I got to call it Max now. I'll still call it HBO though. What happens to the release schedule of everything that was kind of put on hold over the last few months? When does that start to trickle out and hit the platforms?
Well, look, it's going to be very interesting to observe that. I mean, certainly on both the streaming side and on the theatrical release side, a number of people are going to be playing around with their schedules, maybe seeking better dates to accommodate productions that are going to be wrapping up later than planned, and really strategizing around what are the best titles to put out, either as soon as possible if they're complete, those that will benefit from being promoted by the actors in them. There's going to be a number of conflicts, I think, certainly in trying to get actors both promoting existing titles and also shooting upcoming titles. So it's going to be very interesting to see how that plays out. I mean, even as early as yesterday, we saw in the immediate aftermath of a deal being announced, Sony moved their Venom title by a few months. And I think it remains to be seen exactly what the film slate looks like for next year on the basis that it's not necessarily fixed. I think a lot of studios will still be evaluating whether the current dates they've set for their titles still make sense for them.
So what do you make of what's been going on in the movies that have been out? We've seen some giant blockbusters. You had Oppenheimer, we had Barbie, we had Top Gun, and now the new Taylor Swift movie. But between those tentpole films, it's kind of been a vast wasteland. What does it say about the future of cinema as entertainment?
a very good question. I think, you're totally right to say that obviously there were some huge blockbusters over the summer with Barbie from Warner Brothers and Oppenheimer from Universal really being standout films. Certainly as it relates to Barbie, that was, about $1.4 billion in box office receipts, which is really, Warner Brothers' most successful film in its 100-year history. So the summer hasn't been without success stories. That being said, as you rightly point out, since then, it's been a little bit of a drier affair. And I think that without the actors being on hand to promote the films, either in press interviews or at red carpet premieres, it's been very difficult to build up the amount of buzz that's needed for these films to really travel properly.
So I want to go to, really thinking about the potential long-term effects of this. Were there any habit changes, or will we know if people change their habits as a result of I think this is more about the writer's strike and less about the actor's strike. But given that we had, and it's all a similar labor story, Thomas, but given that we had such a long break from late night comedy shows, the late night talk shows, a lot of investment went into the reality shows. I'm wondering if we're going to start to see any sort of long-term habit shifts as a result of this, people moving away from watching those things that were off air for so long.
It's an interesting question. I mean, certainly the same dynamic was observed, during the writer's strike of the late aughts, back in 2007, 2008.
But there were fewer alternatives then. There wasn't, you couldn't go to Netflix, you couldn't go to Hulu then.
That is certainly true, but nonetheless, you did see a surge in investment in reality TV shows, and reality TV really had its moment, I think, in the back half of that decade when everybody thought, this is where the future is and the money to be made, and it's also a very good insurance policy against future strikes. The truth of it is, I think there's still a huge amount of appetite for scripted content, and as a result of that, people will tend to gravitate back towards it, even after a period of reality TV shows. I think the difference, as you very rightly point out this time around, is that the sheer availability of existing content on streaming services meant that people actually thought, despite there not being anything necessarily new out this week on the basis there is a writer's strike, I can nonetheless catch up on all the scripted content that I've been meaning to catch up to and wasn't able to over the past couple of years, given that we were still in the tail end of what I suppose you could call peak TV, with a volume of shows that is simply unprecedented for all of us to catch up on.
So Thomas, let's break some hearts and tell some secrets. Reality TV is often called unscripted TV, but those of us who work in the business,
say it ain't so.
It turns out to be surprisingly scripted. How were they able to get around a writer's strike when everything you see is edited, manipulated, structured, based on some showrunner driving the narrative, driving the storyline?
So that I couldn't possibly answer on the basis that I'm not on the sets when these decisions are made. That being said, maybe everybody involved in a quote-unquote reality TV show was given their briefing notes and storylines early on in the process and knew exactly which line to track. But that's purely an assumption on my part, and I'm speculating now. So, yeah, with the absence of actually sitting on these sets, I couldn't possibly know.
Okay, Thomas, give me 30 seconds on Disney. I promised we'd save a little bit. You wrote the story on earnings. You were on the call yesterday. We know about the cost cutting. Give us your take day two.
Yeah, it's very interesting. I mean, so Bob Iger has pledged to cut an extra $2 billion out of the business, bring the total tally of cost cuts on an annualized basis to $7.5 billion. And I think that what it really does is it complicates the narrative for billionaire activist investor Nelson Peltz, because it seems as though Bob has really taken an approach now to favor operational gearing, to get the company back to growth. And so I think that it complicates the narrative for an activist investor to come in and say, look, this is what I do differently, because it seems as though at this point, Bob is trying his best to activate from within.
Thomas Buckley, thank you so much for joining us. We love it when you join us. He's entertainment reporter at Bloomberg News. He's in our LA bureau. He knows all things when it comes to the writer's strike that has ended more than a month ago, the actor's strike that just ended, and then, of course, Disney, which he's been covering and writing about throughout the day today. Hey, let's get a check on the latest world and national news. We got Nancy Lyons in the 99.1 Newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The Biden administration is placing more pressure on Israel to curb civilian deaths in Gaza as Israel wages war against Hamas following that attack in Israel. The president today said it's taking longer than he'd hoped for Israel's prime minister to follow through with some of the White House's suggestions. White House National Security spokesman John Kirby says Israel is taking steps concerning the safe passage of civilians and humanitarian assistance into Gaza.
We understand that Israel will begin to implement 4-hour pauses in areas of northern Gaza each day, with an announcement to be made 3 hours beforehand.
Kirby says the process is beginning today. President Biden is celebrating the United Auto Workers' success in reaching new contracts with the big three automakers. He traveled today to a newly revived Stellantis plant in Belvidere, Illinois.
The president took off his jacket and donned a red union T-shirt as he cheered on the goal of organizing the non-union companies.
The iconic big three are going to still lead the world in quality and innovation because of you. You guys sacrificed to save the automobile industry, and now the auto companies were doing incredibly well. So auto workers should be doing incredibly well as well.
The workers fearing loss of jobs from the switch to electric cars, the president said China wanted to dominate electric vehicles. He won't let that happen, adding that his predecessor would have. In Washington, Irv Chapman, Bloomberg Radio.
Senate Democrats seeking to hold the Supreme Court accountable for ethical lapses ran into some roadblocks from Republicans today. Democrats on the Senate Judiciary Committee were seeking to subpoena the wealthy benefactors of some of the most conservative justices, but Republicans on the committee proposed more than 80 amendments, forcing a vote on a later date. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ ended today's session in the red. For the S&P 500 index today, we had a 35-point drop, down today by just about 0.8%. Dow Industrials down 235 points today. That was a drop of 0.7%. NASDAQ down 128 points for the NASDAQ Composite Index. That was a drop of 0.9%. 10-year yield now at 4.63%. The 2-year 5.02%, 5.02 on that 2-year. Spot gold up $8 the ounce to $19.58, up 0.4%. West Texas Intermediate crude up 0.3%, $75.55 a barrel. Brent, by the way, holding below $80 at $79.89. Bitcoin today up 2.6%, 36,524 on Bitcoin. Bottom line here, Treasury yield surge. Stocks finish lower as Fed Chair Jay Powell threw cold water on Wall Street's dovish wagers. In the meantime, criticism today for Fed Chair Jay Powell and the Fed from Nancy Tengler, CEO of Lafleur Tengler, and she was a guest right here on Bloomberg Business Week.
It just astonishes me that the market sort of, breathes a sigh of relief when they're dovish, and then the next day someone comes out hawkish, and we get this, the same kind of reaction. And yet, at every turning point, not only has the dot plot been wrong, but a lot of the chairman's policies have been wrong.
And you can hear more of that conversation on the Bloomberg Business Week podcast. A firm holding shares rallied today after the buy now, pay later company posted fiscal first quarter revenue that beat estimates. A firm up today by 14.25%. Also surging after earnings, Bloom Energy, the hydrogen fuel cell company, reported better than expected adjusted earnings per share for the third quarter. Bloom Energy today up by 8.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. Check out the new Bloomberg Business app. It features Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs anytime, including Masters in Business. Just download the Bloomberg Business app on your smartphone and connect your phone to your car. It's free in the Apple App Store or on Google Play. Thanks so much to our sponsor, Interactive Brokers. This is Bloomberg Business Week. Tim Stenevec and Barry Ritholtz in for Carol Massar this afternoon. Now, We should talk about something, what we learned about fund managers from Bank of America, Barry. Active fund managers focused on large cap stock trades notched their biggest hit rate in 2 years last month. Are you an active manager?
Not really. I mean, we're really an asset allocator. We own broad swaths of value investing, emerging markets, broad indexes. The only thing that we do actively is tax loss harvesting, although we're not a pure passive manager because there's no such thing. If you have, are you equal weight to the global market? Probably not. Are you somewhat overweight to the U.S. market? A little. You know, when you look around, you have to make some sort of decisions. But for the most part, we want to allow the market to work for us rather than think we can beat the market, because the data says after 10 years, 99% of active managers fail to beat their benchmark net of fees. Why do I want to play for the losing, 99%? I would rather get what the market gives me. You do that consistently over 20 years, and you're in the top quartile of returns.
And you know what? Still, there are so many people who think that they can go out and beat the market each and every year. And we love them because we love talking about them here on Bloomberg. And also, I think it makes a market.
You know, I have a personal cowboy account, and we recommend this to people who have that itch. They feel that they can pick stocks or time sectors or, trade options or whatever it is. Take a couple of % out of your liquid portfolio, set up a goofy account, and have at it. Hey, if it goes up 20x, that's fantastic. The reality is that if it was all your money, you would never have the patience to let it do it. And if it crashes and burns, hey, it's 2%. Who cares?
Well, we got Alexandra Stepanova in here with us right now. She's equities reporter at Bloomberg News. She writes Taking Stock quite frequently. Check out today's Taking Stock because it's really interesting. It talks about the more than 2/3 of U.S. mutual funds with a bias toward bigger market caps outperformed the broader Russell 1000 benchmark in October. They had kind of a secret, though, Alex. What was their secret?
Yeah, so it's great to be on with you guys. Thank you so much for touting the column, Tim. We really appreciate it. So large cap managers did post their best hit rate in 2 years. That is the percentage of positions that have generated positive returns over a given period. And this happened for 2 reasons. The first is because they had a bias toward large cap stocks within the Russell 1000 index, which held up better during last month's rout. And then the second is because they steered clear of Tesla. Sometimes avoiding a stock could really be the deciding factor in performance, and that was really the case last month because Tesla was down 20%, making it the biggest detractor from benchmark performance over the period.
So that's the key phrase there, benchmark performance. I have to ask the question, how much of this hit rate is that these, I'm using air quotes, active managers are really closet indexers?
Yeah, I mean, what you were saying earlier is really interesting because everyone is talking right now about how it's the time to be a stock picker, right? After the massive rally that we had in the first half of the year.
It's always the time to be a stock picker,
if you're a stock picker.
Right, I mean, we hear that
if you're
every
really
quarter.
good at it.
Right.
But, after this massive rally, there's a lot of uncertainty about the staying power of equities for the rest of the year and into 2024. But the S&P 500 is still up 14% year to date.
And here we are, 10 months and change. 14% is a good year.
Right.
Forget if we even get a Santa Claus rally, who knows what it's going to look like. That said, we know the equal weight S&P is negative for the year, and the Russell 2000 looks pretty ugly. So it seems to be big cap or nothing these days. That's probably why these active managers that lean big did so well.
But why are they steering clear of Tesla right now?
So that's a good point.
Because a lot of the run-up that some of the active managers had was because they took an early position in Tesla, and that thing turned into an oak tree.
But when everybody figured out it was going to be added to the S&P 500, they front-ran it.
Yeah.
But the question is, and this is my question, what is happening now that there's competition from other hybrid and EV manufacturers, and what has his ownership of Twitter done to his
Barry,
EV
it's
buying
called
fan
X.
base?
It's called X now.
I think a lot of, as we're seeing, there are a lot of ex-owners of Tesla.
Yeah, I think you're right about that.
Well, before we get into Tesla's most specifically, I do want to point out, because you guys mentioned that before it was just focusing on these big caps, which have obviously outperformed other names in the market. But now, even within those names, we are starting to see a divergence. So before we had AI euphoria, everyone was really confident that we'd get a soft landing. And so these companies were moving in lockstep. And now there is focus on these individual names. And you can see that in the performance last month, with Tesla being that massive detractor, while some of the other mega caps did hold up much better. And of course, Tesla's problems have to do with the fact that there's uncertainty now about demand for electric vehicles, given macroeconomic uncertainty broadly. Of course, there are issues with Elon Musk's ownership of Twitter and how he's handling that company and whether he's taking away from Tesla. Today, specifically, Tesla got a downgrade from HSBC. They specifically pointed out their concern about delivery timing on the cars. They also said something really interesting. They said that Elon Musk is pretty much essential to the company, but also a risk.
So that's fascinating. HSBC is saying that if you manufacture EVs, owning the libs on social media is a bad strategy. Is that?
Apparently, that might be.
Who would have guessed?
The case.
Hey, Alex, what else did you learn from this from Bank of America here?
Yeah, so just that investors are really paying much closer attention to company metrics. They're looking at company fundamentals and growth prospects, and the growth prospects for the Magnificent Seven are actually at an all-time low. So we've seen this year, this massive earnings rally, and next year we're not so sure that it's going to continue into 2024.
Do we ever really know what next year's earnings are going to look like? I love the uncertainty meme. I'm pretty certain I have no idea what's going to happen.
You got 10 seconds, Alex.
I don't envy market forecasters. Obviously, we've been in a really topsy-turvy market, and it's going to be interesting whether the bulls or bears are right in the final less than 2 months of trading.
All right, Alex Semenova, equities reporter at Bloomberg News. She writes about it in today's Taking Stock. Everything we talked about just now. Check out Taking Stock, though, each morning on the Bloomberg Terminal. You're listening to Bloomberg Business Week. Tim Stenevec and Barry Ritholtz in for Carol Massar this afternoon, and this is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Vince McMahon, the billionaire behind World Wrestling Entertainment, plans to sell 8.4 million shares of WWE parent TKO Group Holdings in a deal worth about $713 million at today's close. Virgin Galactic shares rallied after the space travel company boosted its revenue forecast for the fourth quarter. Space SPCE is the ticker on Virgin Galactic. It was up today by 19%. A powerful union of Las Vegas hotel and casino workers has reached an agreement with MGM Resorts International. And with more on that story, here's Bloomberg's Kimberly Adams.
Charlie, it further softens the threat of a citywide strike ahead of a Grand Prix expected to bring 100,000 visitors. The tentative deal coming a day after the union reached its first agreement with Caesars Entertainment. The labor group must also reach a pact with Wynn Resorts by 5 a.m. tomorrow to avoid a strike. All three casino operators are racing to reach a deal with Culinary Workers Union Local 226 before a Formula One race weekend that kicks off November 16th, projected to bring the city nearly $1.3 billion, more than double the economic impact of the Super Bowl scheduled for February. Charlie?
And that is Kimberly Adams reporting. MGM shares lower today by 1.1%. Wynn Resorts down today by 2.4% after the close of trading. Wynn reported adjusted EPS for the third quarter that did beat the average analyst estimate. And those are our top company stories at this hour, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenivek and Barry Ritholtz in for Carol Masser this afternoon. Let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Democrat Joe Manchin, the senator from West Virginia, says he will not be running for re-election. He made the announcement today in a social media post.
I believe in my heart of hearts that I have accomplished what I set out to do for West Virginia. I have made one of the toughest decisions of my life and decided that I will not be running for re-election to the United States Senate.
The 75-year-old Manchin says what he will do is travel the country and speak out to see if there's an interest in creating a movement to mobilize the middle and bring Americans together. For the last few years, Manchin has been the only Democrat elected to statewide office in West Virginia. He is a longtime politician there. He served as governor, secretary of state, and as a state legislator. The top Democrat in the House is warning of a possible government shutdown next week. House Minority Leader Hakeem Jeffries called on Republicans to work with Democrats to keep the government open beyond the November 17th deadline. He says if that doesn't happen,
the only approach is to pass a continuing resolution at the fiscal year 2023 levels. Period. Full stop.
Jeffries says Democrats in the House will not pay, as he calls it, a single right-wing ransom demand from Republicans. Speaker Mike Johnson has yet to roll out a plan to fund the government since securing the Speaker's gavel last month. Israel is agreeing to a 4-hour daily humanitarian pause in fighting in northern Gaza to allow civilians to flee. The U.S. National Security Council spokesman John Kirby.
We've been told by the Israelis that there will be no military operations in these areas over the duration of the pause, and that this process is starting today.
Kirby says the Israelis have committed to announcing each 4-hour window at least 3 hours in advance. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Tim and Barry.
Thank you so much for that update, Nancy Lyons. Really appreciate it. Tim Stenivek and Barry Ritholtz in for Carol Masser this afternoon. So this story crossed yesterday, Barry, and it reminded me that there's this kind of price war going on between Eli Lilly and Novo Nordisk when it comes to these GLP-1s. So on one side, you have Novo Nordisk out of Europe. This year, the performance of the company as a result of Ozempic and Wegovy has just been incredible.
Right, huge win.
Huge win, I mean, causing like demographic shifts in the country as a result of GDP. Now you have Eli Lilly out of Indianapolis getting their own version approved by the FDA for weight loss. So they had this GLP-1 drug, Mounjaro, and yesterday we heard from the FDA and Eli Lilly that it's been approved for weight loss. And I want to talk to you about this because so many of these consumer companies have come out, and you actually asked Nancy Tangler about this.
Yeah, with Starbucks, because
Yeah.
they make so many, high sugar, sweet, high calorie desserts.
Do you think there's anything to this concern that these companies have?
So I suspect, and this is just spitballing again, I have no data to back this up, we go through these regular fads with weight loss and diet, and a different one seems to come along. It's a $40 billion industry. Ask a doctor if you want to lose weight, they'll whisper in your ear, eat less food.
No, it's very
right?
revolutionary.
However, something like these drugs that function as an effective appetite suppressant, where it's not that you don't eat, you just feel less hungry, you get filled up sooner, you're satiated sooner, and people report significant weight loss up until the point they stop the drug.
And we know.
So is this for real? Is this lasting or not?
Well, look, I think there's a lot of research that needs to be done. What we do know is that Madison Mueller here at Bloomberg News, who covers this, has said that these companies are also right now working on, these are injections right now, and that's tough for a lot of people, and they're very expensive. We don't know if insurance is going to cover
Although
these.
we're in the middle of what looks to be a very competitive marketplace.
It does, and I think you have to wonder if insurance is going to cover these for weight loss, because that can lead to other health concerns being alleviated.
Think about what it does to outcomes for high blood pressure, diabetes, heart attack, huge.
All that stuff. Hey, we're going to chat more about this a little bit later, but check out the story at Bloomberg.com or on the Bloomberg